Welcome back to the Deep Dive. We're cutting through those dense corporate reports to give you the strategic knowledge you need, and fast. Today, our mission is really zeroed in on the financial and strategic heart of Hims and Hers Q3 2025 results. We're specifically pulling out the roadmap laid out by their Chief Financial Officer, Yemi Okupe, in his opening remarks.
Yeah, and this focus is crucial because, it's less about celebrating past wins and more about understanding the build for tomorrow. We're really looking at the financial discipline behind their pretty aggressive growth strategy, how they're taking today's success and immediately reinvesting it, plowing it back in to build these future growth engines. Where the money's going tells you everything.
Absolutely, and Q3 definitely provided the fuel for that. I mean, the scale was huge. Revenue grew 49% year over year, getting close to $600 million. And adjusted EBITDA margins over 13%. The CFO pointed straight at innovative offerings and really leaning into precision medicine as the drivers here.
Seems like more than just basic growth, right? It feels like a strategic shift.
Definitely a shift. Okay, so let's ground ourselves in those foundational numbers first. Revenue, like we said, almost $600 million, that 49% jump year over year. And profitability, it absolutely kept pace. Adjusted EBITDA grew more than 50% year over year to $78 million. That's some serious leverage.
Phenomenal leverage.
But then the subscriber base, it added just over 30,000 sequentially. That's a 20% year-over-year growth rate. So why the gap? Revenue's scaling almost twice as fast as the customer count. What's happening there?
That's the key point, isn't it? And it really signals this fundamental shift. They're attracting a different type of customer now, offering more complex, personalized treatments. So they're just generating a lot more revenue per user. But if you look at how the CFO frames the business engine, he's clearly identified three kind of distinct foundations for growth, for multi-year growth.
Right, so it's not just one monolithic thing. It's like three pillars supporting the growth.
Exactly. You've got, first, the core Hims brand in the U.S. Second, the Hers brand, also U.S., which is growing incredibly fast. And third, that expanding portfolio of international markets. Think of it like a triple-engine plane. Each needs its own fuel, its own capital strategy.
Okay, let's unpack those U.S. brands then, because there's definitely a strategic, maybe even a bit risky shift happening, especially with Hims. It looks like the focus is moving away from those, quick, generic, on-demand sexual health things, the easier stuff,
right,
towards more personalized daily treatment plans.
Yeah, and this is a very deliberate move, highly calculated. It's kind of the difference between selling, mass-produced widgets and building custom furniture. The CFO is intentionally steering Hims away from those transactional customers, the ones who dip in for one generic thing and leave. They want relational customers, people looking for ongoing personalized care. It's a stickier model, right? Much higher customer lifetime value, or CLV.
And he was pretty open about the fact that this pivot is creating a drag right now, wasn't he? I think he noted that if you actually strip out that transition effect, if they hadn't started moving away from the generic stuff, Q3 subscriber growth would have been over 40% year over year.
That's the critical piece you need to hang on to. They're taking a temporary hit on growth numbers. It's a calculated risk because they're building what they believe is a more durable, more valuable customer base in the long run. They're not chasing short-term volume. And they expect this negative effect to mostly fade by the second half of 2026. Then you combine that with new things like testosterone treatments coming online, and they expect Hims to start accelerating again.
Okay, that makes sense. Okay. Now, switching gears to Hers, that momentum is just, it's almost like a different company inside the company. The CFO highlighted growth near or even above triple digits for several years running, and the brand is apparently on pace to hit over $1 billion in revenue in 2026.
Hitting $1 billion for just one brand, yeah, that's massive in this direct-to-consumer health world. And the acceleration, it's all about entering these huge, often underserved markets. Think menopause support, massive area, often overlooked, plus the diagnostics they're bringing in, longevity focus. Hers is morphing, really, from maybe a beauty and wellness focus to a comprehensive health platform for women, much broader scope now.
Right. And that kind of ambition moving beyond simple prescriptions to lifelong care that takes serious money. Which brings us nicely to capital allocation. Their cash position is pretty remarkable, isn't it?
It really is. Q3 free cash flow was $79 million, and they're sitting on over $1.1 billion in cash and investments. The CFO explicitly called the balance sheet a meaningful differentiator. And he's right. In digital health, cash gives you options. It lets them play the long game without constantly needing outside funding.
So with all that cash, they laid out 5 main investment areas. And it's not just keeping the lights on, is it? This sounds like building the foundation for future cash generation. Let's start with the verticalization and facility expansion. The scale here is Kind of mind-boggling.
It is genuinely shocking, the physical build-out. They started the year with just under 400,000 square feet. They expect to end 2025 with north of 1 million square feet. 1 million. So you have to ask, why the huge real estate play? It's about controlling the supply chain for these more complex, high-margin products. Gummies need special handling, for instance. And critically, it supports more sterile offerings.
Sterile. That's the key phrase, isn't it? It links directly to things like their GLP-1 weight loss programs.
Exactly. To handle complex treatments, maybe injectables like compounded GLP-1s, you need absolute control over quality, sterility, regulations. You can't just rely on a standard fulfillment center for that. Vertical integration means they control the compounding, the sterile environment, the logistics. It cuts risk and eventually should improve margins. This huge facility investment is basically their stake in the ground for the competitive weight loss market long term.
Okay, second pillar. Expanding new specialties. Low testosterone launched in Q3. Perimenopause, menopause support, and comprehensive lab diagnostics are coming in Q4. These are investments that should start paying back pretty quickly in terms of revenue, right?
They should, yeah. And they pull new users into that stickier, higher CLV model we talked about.
Right.
Then the third area is strategic investments and partnerships, like that Jurail investment they made. This isn't just about financial returns. It's using their cash to build relationships across healthcare. The goal seems to be getting innovations like advanced cancer screening to their users faster and cheaper than competitors can.
Number 4 is kind of the hidden engine room. Technology platform capabilities. The CFO mentioned tech and dev costs went up almost 2 points year over year to 7% of revenue. That's a lot of engineers.
That's 7%? That's them building their moat. They're pouring money into leveraging all the data they collect. Think sophisticated AI-driven treatment recommendations, figuring out what personalized therapy works best for you, plus AI tools like nutritional coaches, smarter chatbots. They're moving from just telehealth to being a data company that delivers health outcomes.
And finally, number 5, international expansion. They had success in the UK, and then boom, the Zava acquisition. That gave them Germany, France, Ireland, Spain, pretty much overnight.
Super strategic use of capital there. Instead of slowly building market by market in Europe, which is complex and regulated, they just bought an established platform. Now they're putting cash into scaling the UK further, prepping for Canada, and already eyeing places like Brazil and Australia down the line. This global infrastructure build, it's absolutely aimed at hitting that big 2030 revenue target, what was it, $6.5 billion?
Okay, final section then, margin dynamics. This is where you see the short-term cost of all this ambition, maybe. Because we saw that strong marketing down to 39% of revenue, a 6-point improvement year over year. That helped adjusted EBITDA margins. But gross margins actually dipped a couple of points, down to 74%. That feels a bit weird. How does overall profitability go up while gross margin is under pressure?
Yeah, that's the key technical bit. And the CFO was careful to walk through it. That gross margin dip was mostly an operational thing. It was driven by shorter shipping cadences for some of those complex weight loss products. Think about it. If you used to ship a 3-month supply and recognize 3 months of revenue up front, but now, maybe for better patient management or dose adjustments, you ship a 1-month supply, you recognize less revenue per shipment within that quarter. The lifetime value might be the same, maybe even better, but the short-term accounting, the gross margin percent looks lower because revenue is recognized faster in smaller chunks.
Got it. So it's not that the product itself suddenly cost more to make. It's an accounting side effect of an operational choice made for better clinical management.
Precisely. They're prioritizing the patient experience and clinical needs over making the Q3 gross margin number look pristine. And this technical pressure, it perfectly explains the message about the future outlook. The CFO was very direct. The huge scale of these investments, the 1 million square feet of facilities, the tech hiring, the global push, it means a temporary pause in year-over-year margin expansion through 2026. They are absolutely unequivocally choosing to build the infrastructure now, even if it means margins flatten out for a bit.
And you can see that clearly in the Q4 forecast, right?
Yeah.
They expect moving these sterile weight loss fulfillment into those new facilities will create a $20 to $25 million revenue headwind in Q4, again, because of those shorter shipping cycles. So what's the upside? Why take that immediate hit?
Control. Controlling the supply chain lets them do things like strategically cut their GLP-1 prices, make it more accessible, grab market share now while others might struggle with supply or pricing. That operational investment enables competitive pricing. And they expect this temporary margin thing to normalize in the second half of 2026 as those newer customers on shorter cycles start stacking up renewals and the revenue recognition smooths out.
Right. And despite absorbing all this change, the full year 2025 projections are still incredibly strong. Revenue between, well, $2.335 and $2.355 billion. That's 58-59% growth. And adjusted EBITDA between $307 and $317 million. Still hitting that 13% margin midpoint.
Yeah, it shows real confidence that the short-term pain, or rather investment, is worth the long-term gain. They're betting heavily that the infrastructure they're building pays off big time after 2026.
So wrapping this up, the core takeaway for you listening is pretty clear. Hims&Hers is making this massive, aggressive financial bet on infrastructure. Whether it's physical buildings, deep tech talent, or global reach. They're doing it even if it means hitting pause on immediate margin growth through 2026. It's the calculated price tag for building a foundation strong enough to support that huge $6.5 billion revenue target for 2030.
And all that capital is fueling a really fundamental shift in the business model itself. The CFO really stressed this. That upcoming launch of comprehensive whole-body diagnostic testing, that's the signal flare for a major evolution. It shifts the whole platform away from just treating known problems, hair loss, ED, weight, towards helping people proactively manage their health, aiming for longer, healthier lives. That pivot towards longevity and prevention, it opens the door to a much wider audience and deepens engagement.
It's the big vision, right? Turning all that consumer data into personalized preventative action. But, it does raise a really interesting challenge, something for you to think about. With all this investment in diagnostics, all this data they'll generate in these huge facilities, how do they make sure that giving people more data actually turns into personalized, affordable action that keeps them engaged? Because data overload without clear steps, that just leads to people tuning out.
Exactly. That conversion challenge, turning data into meaningful action, that's going to be critical. That's what separates a real healthcare platform from just, testing service.
Definitely something to watch. Thanks for diving in with us today. We'll catch you on the next Deep Dive.